Hey guys, it's Katie with Remax of Orange Beach. I'm here in front of this awesome Easter tree. It is March 2023. Today we are going to have about a 30-minute video on the different types of loans that buyers may or may not want to explore as being something they can use here at the Alabama Gulf Coast. So if you are ready to learn more about loans, we have the Carey lending team with us this month. So tune in and thanks for being here. Hey guys, and welcome to Gulf Coast Market Coffee Break. My name is Katie Lanowski-Norris, and we are with Remax of Orange Beach. We have some special guests here today to talk to us about the different types of mortgages. So today, in the time that it takes you to enjoy a quick cup of coffee or tea on your break during the day, our series will be bringing you interviews with local experts, real estate market snapshots, and tours of local communities in our Gulf Coast area. So with that, I will hand it over to Meredith to introduce herself.
I'm Meredith Harris.
And I'm Jeff Brooks.
So today we're really pleased to bring you the Carey lending team. So this is Mike and Jackson Carey. They're powered by Motto Mortgage, and they are experts in their field. I've referred lots of customers to them. They do a fabulous job, and they are very knowledgeable and have the experience to help us, through some of these lending issues. They're going to kind of help us break down the different kinds of loans and to tell you what's available out there. Every buyer is different, and you're going to have different mortgage needs, and it's their job to kind of take all your information and kind of figure out what loan product fits best for your goals and for your financial background. So with that, I think we're going to kind of try to ask them a few questions and turn it over and get some information on the lending process and the different types of loans.
First, if we could ask you guys to give us a little background on the Carey lending team and sort of what you do for everybody.
Absolutely. Thank you, Jeff. Thank you, Meredith. Thank you, Katie. We absolutely love being here. Well, the Carey lending team is a father and son team. I have over 25 years of experience in the mortgage industry, and Jack has a little over a year. But Jack is the brains of the outfit. He does all the technical stuff for me. I know what I know. But yeah, we're absolutely honored to be here with you guys today.
Thank you.
Pretty appropriate that we put both the technical people on the same side.
Right.
Absolutely.
So one of the questions we've got is, there are a lot of different types of loans, and it can get really confusing for some of our customers. Like USDA, what is that? And FHA and VA and conventional and portfolio. There are just so many names out there. Could you maybe give us a little background on sort of each one and, what might be different about them and what advantages or disadvantages one of our buyers might have with each one?
Absolutely, Jeff. I'd love to do that. And we're going to start with conventional products.
Okay.
In today's market, about 80 to 90% of the loans closed are all conventional, either Fannie Mae or Freddie Mac. Those are the two biggest aggregators of conventional loans.
Who are they?
Fannie and Freddie.
Are those people?
Oh, no, I'm sorry. Fannie Mae and Freddie Mac are government institutions, and what they serve in the market is they take all the loans that originated by the Carey lending team, and they aggregate them and bunch them, and they sell them to the secondary market. Now, you may...
And that secondary market is like I could buy them as a stock or
Absolutely.
Investment? Okay.
If you choose to invest in mortgage-backed securities, you could buy some of these batched loans on the secondary market. Now, when I say the Carey lending team may sell a loan or originate a loan to Wells Fargo, they may own the servicing, but Freddie and Fannie own the rights to the papers. They actually dictate where those mortgages are going. But again, a high percentage of loans that we close today are conventional, and you have down payment options as little as 3%, and then you can put down as much as you want to. On some of those loans, if you put down less than 20%, then you could have mortgage insurance. PMI is what they refer to. But there's a lot of ways to kind of bury that PMI into your payment through either a higher rate, or sometimes we finance that PMI. And the reality is, if you have really good credit, that PMI mortgage payment's relatively small, and falls off as you get to a 78% loan to value. Just about everybody is eligible for that product, or those products.
Okay.
So basically, just depending on your down payment is whether or not, and your credit score, be whether or not you'd want a conventional type of loan.
Yeah, when we look at a customer characteristics, we determine pretty quickly what is going to be the most affordable loan for them and the best option for them. So I'll give you an example. If someone has, let's say they have a 740 credit score, they're putting 10% down, that may be a better fit for them than, say, going FHA or possibly USDA relative to the overall APR charges. So it may be a better loan.
So that's pretty key, that you help them figure out which loan best fits their individual situation. Because I think a lot of my customers are, which one do I want?
Right.
And the fact that you can help them figure out which one costs
they provide
less
your information. They provide their information, and you actually give them multiple options based on what would work best for them.
Absolutely. We actually have customers walking in thinking they want a USDA loan.
Yeah.
And then we show them their options, and they choose something entirely different.
Okay, that's key.
Yeah.
Absolutely.
That's a big deal to me. And then I heard a couple of other things in there. The range in the down payment. Their PMI may be lower with a better credit score, and I hear also depending on how much they put down. And then, does their interest rate change based on how much they put down?
Good question, Jeff. Yeah. Let's say someone's putting down 10%. When someone's putting down 10%, the lender has some protection against default through their PMI insurance. So since we have a mitigating factor in mortgage insurance, they would actually get a little better rate. Now, if they put down 20%, the rate may be a little higher until you get down to 75% LTV, because it's very important, especially since 2008, that everybody's protected on these mortgages, because the last thing a lender wants is to take a mortgage back, because that mortgage is attached to a house that no one can take care of, no one can mow the yards. It was a real big hassle for that 2008 crash.
Okay.
You talked about what you do to qualify buyers, but in conventional, the most common type of loan that you guys work with, what about the property? Do all properties qualify for that, for a conventional loan?
Good question. Most properties will qualify for a conventional loan, even if it's unique, as long as we can find comparables out there. Like, for instance, where I came from, there were a lot of log homes, and it was very hard to find comparables for log homes. But if we can find those, all those property types pretty much qualify. Now, there are some unique properties out there that may not, but it's case-by-case basis. Almost all of those, all property types will qualify.
Okay.
There may be some one-offs, but for the most part, they all qualify.
Okay.
So then you had mentioned earlier a couple of different types of the government-backed loans, so to speak, like FHA, USDA, VA. Could y'all go into a little bit of detail about those and how they differ from like a conventional loan, and of course like the property types that may not be allowable under the different types of government-backed loans?
Jack, you want to talk a little bit about USDA?
Yeah, absolutely. USDA is great. The first thing that you got to know about USDA is that they're going to allow you to put no money down. So 0% down, it's really hard to argue with that.
No money down.
0% down.
Okay.
And there are a couple of, circumstances that you have to follow in order to get the 0% down, and that is you got to be in the right area type. There are USDA approved zones, and you got to make sure that that property is located in that USDA approved zone. But the good thing about Baldwin County in our area is that 90% of our area is USDA approved. You got some areas close to Mobile, like Spanish Fort Daphne area, that may not be, but down south here in southern Baldwin County, we're 100% USDA approved. Another big thing about USDA is the income limits. So when USDA is going to measure your income, they're going to look at it as household income. They're not looking at you as an individual, and they're not looking at you and just the co-borrower. They're going to take the entire household's income. And what that means is anybody who's of legal age and is bringing income in, that income is going to be put into the equation.
So like if a 19-year-old kid's in college and lives at home, they're going to look at what that
Absolutely.
person makes also. Okay.
They're going to include that in.
Let me comment on that. If they're in school, then it won't be applicable.
Okay.
If they're 19 years old and they're just living there, absolutely that income has to be considered.
And what is that rough income limit? Does it vary by area?
So it varies by size. If it's a 1 to 4 person family, that's going to be $103,500 or unit.
Close enough.
1 to 4 family size. It's all based on the family size.
And then 5 or more is 136,600, I think, but I might be wrong on that extra 6 part.
I'm impressed that you remember
Let's just use rough numbers because I don't think
136,
anybody's going to remember the exact number.
First one's
But
around
roughly
100,000. Second one's roughly 5 or more is roughly 130, somewhere around there. And that's even grandparents that live with them. If they get Social Security or anything like that, that's going to be counted into the income as well. So that's the biggest piece that we really look at when qualifying somebody for USDA. But if they can qualify, USDA is fantastic. I mean, 0% down is hard to beat. There is the debt to income ratios might be a little bit more strict than maybe a conventional because they have that back end of 43 that they stick pretty hard on.
Wait. I'm 43.
I am going too fast.
No.
So,
we're just breaking it down so everybody understands. So
We're normal human beings. We don't do this every day, Jack.
Okay.
So with the debt to income ratios, they tend to stick a little bit harder than, say, VA, FHA. Their total debt to income ratio, if it's over that 43% mark, they're going to be pretty hard on you usually.
I think what Jeff's asking is maybe explain debt to income. What that means?
Well, the back end ratio,
back end
that's
versus
just
overall
your
ratio.
debt
So
to
that
income
might be
percentage.
Yeah, so front end is your housing expense ratio. So whatever your mortgage, your bills cost divided by your income, that's going to be your front end, that's income. And your back end is that your total expenses divided by total income.
Got it.
So if that
like
back
a
end,
car payment would go on that back end. Okay.
car payments, child support,
electricity,
anything
gas.
really,
Okay, that actually makes sense. I forgot that in real estate school. I think I learned that at one point, but I totally forgot how to calculate that.
Really good.
Okay, so USDA, just about the whole county, but definite income limits and, 100% down, but you still have closing costs to negotiate in there somewhere. So what about FHA?
That has a low down payment option too.
I'll take FHA.
Yeah.
FHA is probably, it meets a couple of buckets. Number one, it's good for first-time home buyers. It's got a little more flexible credit standard, a little more flexible ratio guidance. The 3.5% can come from a gift, 100% from a gift, or a nonprofit agency that's participating with the FHA program.
So somebody, if it's a first-time home buyer, somebody's parents could gift them with the down payment money. That's nice. Okay.
Absolutely, they could gift them the 3.5% plus the closing. A couple things also unique about USDA that we've worked with on some buyers in Baldwin County. Number one is we've used gift of equity with FHA. An example of that would be, let's say a mom is selling a house to a son. Let's say she owes $50 on that house and she wants to sell it for $100. Well, she can give that $50 as a gift of equity so the son can qualify for a loan for $50,000. So those are unique things about FHA and other loans as well as a gift of equity.
That's the first time I've heard that, Mike. Thank you for bringing that up. That's interesting.
And then with FHA also, it's got a pretty liberal credit standard, so we can go down to a credit score of 580. So with no income limit. So I mean, a doctor could make $1 million a year if he's got a 580 credit score. That may be the loan that we put him in because that's what he qualifies for.
Okay.
Are there any special stipulations like inspections or standards on the property for FHA or USDA?
Well, for USDA and FHA, they're going to go out, the appraiser is going to go out and make a visual inspection of the property and inspect things that are common, like does the electricity work, are all the faucets water turning on, is there anything in that property that may have a health or safety issue for the borrower?
Right.
Or is there anything that property, let's say an inspector or an appraiser may go out and he may not be an HVAC expert, but he may look at the HVAC system and say, I recommend a certification on this unit, because a lot of people that qualify for FHA loans or a lot of government loans, they get into a house and they have a $9,000 repair bill because something wasn't checked. Well,
Makes sense.
they could go into default over that, because typically when somebody's qualifying for an FHA or a USDA loan, they're using every bit of their funds to close. So they may not have the reserves that someone else may have.
Yeah, that's great. And that there is a standard for the property for the
Absolutely. They're going to
yeah.
want to make sure that property is safe and marketable.
Okay.
So no holes in the wall, no chip paint, no broken glass.
Does that also apply to USDA or just FHA?
They're going to be looking for those same things. A USDA is a conventional loan, but it uses a government appraisal. So here's something that's kind of crazy that most people don't know. If there's more than 3 steps going up to the front door or the back, or coming out of the back door, you have to have handrails. Absolutely have to have handrails. So there's some uniqueness about it, some got-yous, if you will. Jeff, you mentioned got-yous. So you just got to be careful. I mean, if you have any questions about a property, you may want to call us and say, hey, this is some of the things I've noticed about this property. Is it going to be government eligible?
Okay, so
Very
along
cool.
that same line, I've heard that it can't have window units, or, if it has window units, it can't be FHA, or if it's got septic, or if it's on well water. But those things, correct me if I'm wrong, that doesn't matter as long as everything works and is safe, right?
Absolutely. It doesn't matter, because there's some, like I said, if you're buying a house up north, they may not have central heating and air. They may just use window units. If it's applicable to the area, it's safe, then there shouldn't be any problems.
Okay.
Very good.
So we've talked about USDA, FHA, VA. Is that a good next one to touch on?
Absolutely.
That's
I think
Mike's
so.
specialty.
Absolutely.
One of
Okay.
his specialties.
The number one thing about VA is eligibility. Eligibility is a beautiful thing. So if you have I ask every borrower that walks in the door or calls me on the phone or applies online, do you have VA eligibility? The actual 1003 addresses it. They ask that question, have you served? And if they've served and have eligibility, then that opens up a lot of opportunities. 0% financing. Seller can pay up to 4% in seller contribution, which Meredith and I had a situation where the contribution was used to pay off a car.
Oh, I didn't even know. Okay.
Yeah.
Yeah.
Wow.
I knew the contribution was there, but
Yeah, so we paid off a car with that so they could qualify for the ratios.
And that 4% is of the loan,
Sales
of the
price.
house
Sales
value?
price.
Okay.
And another thing about USDA, as long as they have full eligibility, there are no loan limits. Someone can buy a $2 million house using their VA eligibility as long as they have all their eligibility. And what's unique about VA, I love VA, it's a great program, is that let's say someone buys a home using their eligibility and they want to rent that home, okay, turn it into a rental, and they want to buy another one. They can buy that second home for 0 down as well. And as long as they have eligibility, they can continue to use that VA loan to buy homes.
That was my next question, is with these 3 that we've discussed, does it have to be their primary home? That was my next question. Does it have to be the primary residence?
FHA, USDA, VA, it has to be at origination their primary home.
At origination, their primary home.
Cannot be a secondary or an investment property.
Okay.
Doesn't mean
There
you
was
can't
a
turn
key-
those in.
There was a key qualifier in there, at origination. Are they allowed to, at some point in the future, start renting that home?
Absolutely.
And keep
Yeah.
that loan?
Yeah.
Absolutely, they can. They can turn it into a rental. Let's say now there's some things about FHA. You can't have 2 FHA loans in the same general area. Okay, it's got to make sense. Either the family size changed, or maybe relocating with 100 miles away. You could qualify for another FHA loan. But I can tell you, if you have a VA buyer, those are your best investors, because they can buy and sell property within that VA parameter better than anybody, with very little money out of pocket.
We have to think about VA, they're for our veterans. I mean, even if somebody was currently serving, you buy a house, you get transferred somewhere. Instead of selling the house, you rent it out and you buy a house somewhere else. I mean, that makes sense to me.
There's a lot of myths about VA that we've been busting, like the time it takes to close a VA loan. We can close a VA loan in less than 30 days. We've closed them.
I can attest to that with Mike Carey.
We've closed them in 14 days or less because we're very proactive about ordering appraisal almost day one, so we don't have to deal with that. We get all of our documentation up front. I mean, the one thing the Carey lending team, and I'm not saying this is unique to us, but we try to get all the documents on the front end so we can review them, look for possible challenges. So everybody, we're talking about it, within the first week. Mm-hmm. So we're not talking about it the day before closing.
Nobody likes surprises in the mortgage world.
No.
Well, and that first week for most buyers is a pretty busy week. I think we all set them up to be prepared. You're going to have a lot of work to do in the next 5 days.
Yes.
And the one thing about VA too, just because you served, you may not be eligible. Okay? There's some qualifiers in there. So the first thing we do, if we get a VA buyer, is we check for a COE. We can get those online for most borrowers. I'm sorry, I'm speaking lingo. Certificate of eligibility.
Oh, okay.
So we check that first, and if we can get it online, that's great. And we'll know everything about that borrower if they receive any kind of disability from the government. It'll be on their COE. There's a lot of information on that COE. So I'm a huge VA fan. So that's a great program for those people who qualify.
I like that you said that you've been myth busting lately, and that is kind of a common thing. That it takes a long time to do a VA loan, and not if it's done right.
Well,
we hear that about all the government-backed loans, though,
yeah,
except for conventional USDA, VA. It'll take forever.
Yeah.
Well, when we were in the market in 2021, where houses were putting a sign, they're flying off the shelf. A lot of people were excluding some of those USDA loans, some of those VA loans, because the perception was it took too long. But the reality is, if your borrower's prepared and your loan officer knows what they're doing, you can get these loans closed really quickly.
All right. Well, you've just said it on video, so it's there forever. And you've got the standard now.
And I'm not afraid to back that standard up. Absolutely not.
So I'm certainly not an expert, but I've heard rumors, is it possible to roll some of my closing costs into VA loans, or what are some of the other advantages there for a buyer?
Well, for VA and FHA loans specifically, when people roll in costs, they've either adjusted the sales price to roll the cost in. However, USDA will allow you to finance up to 103% of the appraised value. Okay. An example of that would be if the sales price is 100, contract sales price is 100, and it appraises for 103, you could conceivably roll some of your costs into that loan.
Okay.
Which could be a really big deal for
Absolutely.
A lot of people.
Yeah.
Because,
a lot of people.
like I'd mentioned, most people when they're qualifying for a USDA or FHA loan, they're absolutely using every penny they have to close on that loan. So they may need concessions. They may need to be able to roll some cost in.
Well, and it's almost like our economic system that's been set up wants people to buy a house, isn't it?
Well, there would be some people that say that the government doesn't want you to own homes, but generally speaking, the home ownership rate has been consistently around 60 to 65% nationwide for many, many years. I mean, one of the things I coach my buyers is that is the easiest way to build generational wealth. Mm-hmm. So, I mean, I encourage home ownership. I mean, even with rates today, I still encourage, if you can afford the home, you need to do your best to try to get it. Mm-hmm. Because home prices, generally speaking, are going to continue to rise.
Thank you. Say that one more time.
Say it again.
Home prices are going to do what?
Rise. I mean, literally, it will become unaffordable for a lot of people in the future to own homes.
Well, and I think in this area too, right? I mean, because everybody wants to live at the beach. You know, I've talked to buyers all the time that say, I'm waiting for the market to crash. And I'd say, then you don't want to live at the beach because, you know, we continually appreciate it. It may not be as great as it was over the past couple of years, but my gosh, none of us could afford to live here if it kept going at that rate.
My grandmother told me my entire life, and it took me far too long to understand what she was saying. There's only one thing God doesn't make any more of, and that's dirt. Well, I've since added to that, and he makes a whole lot less of it at the beach. So, you know, supply and demand, if there's not enough out there, then it's going to continue to go up in value over time.
Absolutely. I would encourage anybody, if you can buy and invest in real estate, I would do it. I would try to make it happen. Either, I mean, not occupying co-borrowers, things like that. Because in Baldwin County, specifically for a borrower who's making, say, we met with a young lady this Monday night, and she's making $35,000 a year. It's really hard in some cases to qualify for a home. So, you know, in those cases, we ask, is there anyone that can co-sign, be a non-occupying co-borrower? Because we're in this business to solve problems. And so we're trying to do that every day.
That is a perfect segue into kind of the, excuse me, the other larger non-government backed category, special programs. Maybe something a little bit different that serves someone else's needs in a different way. You know, we hear about portfolio loans. We hear about these special programs that are out there. Can you tell us a little bit about those and
Absolutely.
Sort of what kind of properties or buyers that would be appropriate for?
Absolutely. Two of the biggest things that people are doing today are either bank statement loans or debt service loans. And what debt service means is they take the annual rental revenue divided by the annual mortgage cost. And typically, if that's a one-to-one relationship, you'll qualify. I mean, we're doing one right now. We don't even put the employment on the application. We just put the applicant's name, social security, birth date, and we qualify primarily on the property, its rental
History or projection?
or rental projection.
Okay.
We use a 1007 to give us a rental projection,
That's
or
a
if they have an
special
actual
form.
lease. Yeah,
Okay.
appraiser does it for us.
Okay.
And then credit score and assets. So when I talk about assets, preferably that's a 60-day seasoned asset, and it works much better if all that money's in one account. Can you use multiple
Katie
accounts?
and I both are wondering what a 60-day seasoned asset is. Salt and pepper, oregano.
Your IRA or a...
Yeah, 60-day seasons. It's been an account for more than 60 days.
Okay.
60-day seasoned asset.
So you've had the funds for more than 60
Yeah.
days.
Yeah.
And could that be
That's
like
not long.
land or a house, or does it need to be cash in a bank of some type?
The more liquid, the better.
Okay.
But you can borrow
401ks
from.
and IRAs are not quite as liquid as, say, a savings account. But
Well, they're liquid because you can take a distribution, you can take a loan,
Okay.
you can, depending on what your administrator and what they allow. That's always. I mean, we get people. We ask those questions. Do you have an IRA? Do you have a 401k? Can you borrow from it? Can you take a distribution? But primarily, when you're talking about bank statement loans, they're looking at a client's bank statement or bank statements over a 12 to 24 month history. They're looking at, what kind of deposits, and they're also, if you don't have a CPA loader, they're going to look at those deposits and reduce it by 50% expense ratio. So you got to be real careful. So what we do, and most lenders do this, I'm not saying it's unique to the Carey lending team, but we try to get those bank statements up front and get them reviewed so we get those income questions out of the way, because once that income is underwritten, it's good to go.
What sort of down payment are we looking at?
Typically, when they first started rolling these programs out, they wanted 25 to 30% down. But I just got an email from an investor that will do one at 15% down.
Okay.
Now, when the higher the LTV, then obviously the higher the rate could be. So, we try to
Loan to value.
Yeah, loan to value. You got it, Jeff.
Yeah, so if you're putting 15% down, your rate's going to be higher than if you're putting 50% down.
Yeah.
Which makes sense.
When we discuss these programs with borrowers, we're pretty specific about the qualifications. We're very transparent about the rate because they do carry higher rates and higher points. But again, the more you put down, you mitigate some of that risk, so you qualify for a lower rate. But with rates where they are today, we're very particular about how we explain that and the impacts on DTI, things like that. So it's because it's important.
So I've got a logic question there. Okay, there's a lot of focus on the rate right now, but if my rentals are servicing the loan and I'm building equity in an asset, maybe I'm not building it as quickly as I was when loans were crazy at 2.5% or 3%, but I've still got somebody else buying an asset for me, don't I?
Absolutely. I think as long as that relationship's one-to-one, Jeff, then we should qualify. But the reality is, in today's market, you got to look at two things. Are you covering your debt? And then are you appreciating at a reasonable rate? Because you may not cash flow.
Right.
You know, you may cash flow very little, maybe $100.
Until my 7 or 10 year turnover, then that's a different analysis than the first 3 to 5 years when I'm holding it.
Yeah. And then too, we encourage all borrowers when there's an opportunity to refinance to do so. And one thing about some of these is exotic, or what we refer to them as non-qualifying mortgages, is they often carry a prepayment penalty. So you have to understand that. Typically, they'll go from a 1 year to a 5 year, and if you buy the 5 year prepayment penalty, you'll get a better rate, and that penalty is typically 6 months worth of interest at payoff.
Okay.
Oh, I've learned a lot today.
Same here.
That was a lot.
Yeah. We'll have
I
to go
wonder
back
if it
and
was too
rewatch
much.
that. We
I
have
wonder
to
if
go
it
back
was
and
too much
rewatch it
for
a
our
few times.
audience. So
Nah.
we'll have to
We'll
figure
just have
that
to
out.
watch it a couple times.
Yeah, and I think if anybody has any questions, we can point them in the right direction.
Obviously, yes.
Mike and Jackson.
Absolutely.
Well, we thank you guys for being here. Did we leave anything out?
That's the right question. Did we, we're certainly not the experts here.
You know-
What should we have talked about and didn't give you a chance to?
Well, here, Jeff, Katie set the parameters. I'm done with my coffee. So I think we covered everything from a pretty comprehensive, high-level discussion. If you have any questions, you can obviously give us a call.
And we will flash up their
Yes.
contact information on the video, so you will have that. And you can reach out to them. They pride themselves in personal service and providing the product that is right for you, not necessarily, right for them. So does anyone have any?
No, I'm
No,
just
let's
so
just
grateful.
thank our
Yeah.
audience.
And
Thank you
y'all for
guys.
being
Thank
here.
you for watching. I hope that was helpful. We will see you next time.
Good morning, Jeff Brooks, Remax Orange Beach here for this month's market focus. If you remember last month, we did a short focus on 3-bedroom, 2-bath homes in the residential areas. This month, we're going to look at 2-bedroom condos. First, we're going to take a look at the report we send out each month from Baldwin County that summarizes both traditional and resort or island-based properties. And you can see both of those were up February this year from February last year. That report we send each month also has this breakdown by area for you, but that's not the real purpose of today's session. Today's session is about the focus on condominiums. I had to narrow it to Gulf Shores because we had over 900 records. When I tried to do everything, we'll take a look at Orange Beach on another one sometime. Gulf Front, 2-bedroom, closed, pending, or for sale from January of 21 all the way through a few days ago, mid-March 23. And we did this because it's a really popular search or request from lots of our buyers. This is just a sample of the data, way too much to put on a slide, way too much to understand just by looking at it in detail. So let's turn it into something a little bit easier. We looked at it by quarter. First column there is the number of properties that sold I will caveat that Q1 23 has about 30 properties that are still for sale in there, so it's a little bit skewed. Then we've got the average price per square foot, the percentage change quarter over quarter for both the price and the per square foot. I like pictures, so I've turned that into a graph on the average price and the price per square foot, and you can see it went from just over 400 to mid 500 from that January or first quarter 2021 to this quarter of 2023. And the average price per square foot rose as well. You see a little bit of a flattening on the price per square foot over the last 3 to 4 quarters. Says, the market's starting to normalize back to where we were before the world went crazy, in my opinion. Here's some of the detail behind that. The one on the left is the quantity sold each quarter. You can see that first quarter tends to be a big sales period in this market because people are getting ready for the rental season. And then the one on the right is that percentage change on price in the orange column and price per square foot or dollar per square foot in the blue line. Again, you did see a little bit of negative growth on the price per square foot back from Q2 22 to Q2 20 or Q3 22. But you can see it started to come back up again and showing growth again. Thanks again. Hope you like the data. Let us know what you'd like us to focus on. We'll put something together for you. Have a great day.